So following the Great Recession and financial crisis of 2008 and 2009, the Federal Reserve Bank changed their primary tools for using monetary policy. We're going to talk about those changes here. So the Fed's goal is still the same. It's still a dual mandate. That is to achieve price stability and low unemployment. But how they do that is a little bit different. Monetary policy is using the money supply to impact the economy. So let's take a quick look at the economics of that. So to explain how monetary policy works, I've got two graphs up here. One of them shows the money market, the demand for money, and the supply of money, which is set by the Fed. And the other shows an investment function, which shows the relationship between the interest rate and the level of investment in the macro economy. So if the Fed is seeking to expand the macro economy using monetary policy, they'll expand the money supply. We'll talk about the tools that they use coming up, but once they expand the money supply, banks have more excess reserves which can be used to make loans, which puts downward pressure on the interest rate. So going from equilibrium A to equilibrium B, after the supply of money is expanded, the interest rate will drop from say 10% to 8%, and the quantity of money will expand from QM1 to QM2. So if we show this on the investment function, at an interest rate of 10%, the level of business investment is here at point A. A lower interest rate, 8%, incentivizes businesses to borrow money and expand their operations at a lower cost of borrowing money, thus expanding investment, thereby expanding the economy and increasing GDP. This is the basic premise of expansionary monetary policy. Prior to the financial crisis, the Fed used three tools to expand the money supply: the discount rate, the reserve requirement, and open market operations. The discount rate is the rate at which banks borrow money from the Fed to increase their reserves. The reserve requirement is set by the Fed, and the reserve requirement is the percent of deposits a bank must keep in their vaults and can't loan out. By lowering the reserve requirements, give banks the ability to loan more money, thereby expanding the money supply. Open market operations is the buying and selling of government securities. By buying government securities on the open market, the Fed can expand the money supply. Following the Great Recession, the Fed adopted a new tool to be able to expand the money supply when needed. It's called the ample reserve regime. Ample reserves is the sum of cash banks hold in their vaults. So an ample reserve is that there's enough cash in banks to maintain a stable interest rate in the economy. So rather than using open market operations, the buying and selling of government securities, to influence the federal funds rate, the Fed uses a different tool, and it's called interest on reserve balances, or IORB. The IORB is the amount of interest the Fed pays banks for their excess reserves. Let's explain how this tool works. Let's take a look at the Federal Open Market Committee's latest statement. In the statement, they're targeting a federal funds rate between 0% and 0.25%. Their goal is to maintain a level of reserves that keeps the federal funds rate at that level. They can do that by adjusting the IORB. The IORB is set by the Fed. It's not a market-determined interest rate. That means the Fed can nudge it up or down in order to maintain ample cash reserves in the economy to achieve the federal funds rate that they wish to achieve. So let's look at an example to explain how this works. Let's suppose that the IORB is equal to 3%. And let's say that the federal funds rate is equal to 2%. Remember, the federal funds rate is the interest rate that banks earn on overnight loans to other banks. So if the IORB is greater than the federal funds rate, banks have incentive to take their excess reserves and place those dollars in the Fed, essentially taking those dollars out of the money supply. This would cause the money supply in the US economy to contract, would drive up interest rates, slow investment spending, and decrease aggregate demand, thus slowing the economy. Let's take another example which shows how the IORB can be used to expand the money supply and achieve a higher level of spending in the economy. Remember, the Fed could nudge the IORB up or down. If it's greater than the federal funds rate and the Federal Reserve Bank wishes to expand the economy, in this case, they might nudge the IORB downward. So instead of 3%, let's assume that they reset the IORB to 1%. Now it's lower than the federal funds rate. So that's a disincentive for banks to place their excess reserves at the Fed, removing it from the economy. Now banks can earn more money by loaning money to other banks at the federal funds rate. That means that a bank's excess reserves stay in the macroeconomy. If they stay in the macroeconomy, that means the money supply will expand because excess reserves are greater. There are now ample reserves in the economy to maintain a greater amount of loans and excess reserves to stimulate the economy. So as the money supply expands, it will ultimately begin to put downward pressure on the overall interest rates in the economy as the money supply expands. That lower interest rate will encourage more investment spending, thus shifting the aggregate demand curve outward. So that's an overview of the ample reserves regime used by the Fed as opposed to open market operations to expanding the money supply and stimulating the economy.